Welcome to the deep dive.
Yeah.
Today we've pulled a massive corporate earnings report specifically for you.
Yeah, because you really need to see how the fundamental rules of the vacation industry just got, well, completely rewritten.
Exactly. I mean, usually when we talk about a massive global corporation facing a sudden $500 million economic headwind, there is this expectation of panic.
Oh, for sure.
It is like watching a slow-motion car crash. You see the warning signs, the quarterly projections get slashed, and Wall Street just braces for impact.
Right, because the outcome in those scenarios is typically very binary. The baseline cost of doing business spikes, and the bottom line inevitably craters.
Yeah.
It is just basic corporate physics.
But then you step into the world of global travel and leisure, and suddenly that predictable corporate physics just breaks down.
Completely falls apart.
Right. The financial landscape we are looking at right now is honestly mind-bending. So our mission today is to decode a massive financial turnaround.
Which is quite the story.
We're going to figure out how Carnival Corporation, one of the largest travel conglomerates on Earth, managed to post record-breaking profits while navigating a massive economic storm.
Yeah, and we are looking specifically at their Q1 2026 earnings report, along with their accompanying strategic presentation.
So we are going to unpack their newly announced corporate strategy and show you exactly how the cruise industry is fundamentally changing the way you plan and, more importantly, how you pay for your vacations.
And the raw numbers we're looking at in this Q1 report are frankly staggering when you consider the broader macroeconomic context.
Give us the highlights.
Well, we are talking about record first quarter revenues of $6.2 billion.
Wow, $6.2 billion.
Yeah, and alongside that, they posted a record adjusted EBITDA of $1.27 billion, which actually beat their own internal guidance.
Okay, let's unpack this because the context is what makes that $6.2 billion revenue number so crazy.
Absolutely.
In this very same report, Carnival outlines a massive $500 million plus headwind from higher fuel prices.
A huge hit.
Right. It's like driving a massive fleet of 18-wheelers right as gas prices spike to the moon, yet somehow you end the quarter more profitable than ever.
It seems impossible on paper.
Because they also reported an adjusted EPS or earnings per share of 20 cents, which is up 50% compared to the prior year.
And that beat guidance by 7 cents, too.
Exactly. But before we go further, for those of us who don't read financial balance sheets for fun, what do adjusted EPS and EBITDA actually tell us in plain English?
Sure. So think of it this way. Your revenue is the total amount of money coming through the front door.
Right, the top line.
Exactly. But EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, is a measure of the pure cash profit generated by the actual day-to-day operations of business.
Ah, so before the accountants and the tax man take their cut.
Precisely. And then adjusted EPS simply breaks that profitability down to a per-share level for the investors. So when Carnival beats their EBITDA guidance, despite fuel costs skyrocketing, it means the core machinery of their business is running with incredible, unprecedented efficiency.
But how exactly does a company absorb a $500 million hit to their absolute primary operating cost without sinking the ship? I mean, you can't just ignore a $500 million bill.
You certainly cannot ignore it, but you can outrun it.
Outrun it.
Yeah, they did this through a relentless, almost surgical focus on operational efficiency. If you look closely at the data, their revenue growth completely outpaced their cost growth.
Which is exactly what you want to see.
It is the holy grail of corporate health. Specifically, they generated an operational improvement of about $150 million to the bottom line.
That is massive.
It is. And that $150 million acted as a massive shock absorber against those fuel prices.
So they basically tightened up their internal operations so much that they found an extra $150 million in the couch cushions.
Essentially, yes. Though this wasn't magic, it was just really good math. Their gross margin yields increased by nearly 10%. They optimized how they staff the ships, how they purchase food, and how they manage their supply chains.
So everything is just tighter.
Exactly. It was all managed so effectively that even with fuel prices acting as a massive weight around their ankles, their underlying engine was just running hotter and faster.
So the engine is running hotter, but an engine needs fuel, or, in this case, passengers.
Right.
And I saw something in this report that really made me do a double take. Customer deposits. Like the cash people are putting down to reserve a room hit a first quarter record.
A staggering $7.9 billion in customer deposits.
That is insane.
It really is. That is up nearly 10% from the first quarter of 2025. You see, the only way you beat those massive external fuel costs is through unprecedented consumer demand.
You just need cash flow.
Exactly. You need a tidal wave of cash coming in to offset the cash going out, and that $7.9 billion is exactly that tidal wave.
Here's where it gets really interesting. It's not just the people who are booking, it's when they are booking.
The timeline is wild.
Right, because the report states that nearly 85% of their 2026 sailings are already booked.
Yep.
Their bookings for 2026 are up double digits, and their 2027 bookings are already hitting record levels.
Which is unprecedented.
We are sitting here early in 2026. I have to ask, are we just looking at consumers panic buying vacations years in advance?
It certainly looks that way.
I mean, is it normal for people to lock in their 2027 plans before we are even halfway through 2026?
Yeah.
Because surely that psychology backfires if a recession hits and people suddenly want those deposits back.
That is a very valid concern, but you have to understand the specific mechanics of cruise bookings.
Okay.
A large portion of these deposits are non-refundable, or they come with significant cancellation penalties as you get closer to the sail date.
So they are locked in.
Pretty much.
Yeah.
But to truly understand the leverage this early booking behavior gives Carnival, we need to introduce a nuanced cruise industry metric called ALBD.
ALBT.
Yes, which stands for Available Lower Berth Days.
Okay, lower berth. I assume that means the physical beds in the cabins.
Yeah, precisely. It assumes 2 passengers per cabin, and it is the standard measure of daily capacity across the entire industry.
Makes sense.
What the data shows is that Carnival's booked position for those ALBDs is at historically high prices.
So they aren't just selling rooms, they are selling them for top dollar.
Exactly. Think about the leverage here. When you already have 85% of your entire year's inventory sold out, you do not have to offer desperate last-minute discounts to fill empty rooms.
Oh, wow. Yeah.
You have incredible, almost monopolistic pricing power over that remaining 15%.
So if I want to book a last-minute cruise today, I am paying a massive premium because I'm basically fighting over scraps.
Exactly. You are paying the premium. But the part of this consumer behavior that I actually find most fascinating isn't just the ticket sales.
What is it?
It is the massive acceleration in pre-cruise onboard revenue.
Oh, you mean people buying their drink packages, specialty dining, and shore excursions before they even pack their bags?
Yes, and the psychology behind this is brilliant. Well, when a guest pays for their unlimited Wi-Fi, their steakhouse reservations, or their snorkeling excursions 6, maybe 8 months in advance, a psychological trick occurs.
I think I do this myself, actually.
Most people do. By the time they actually board the ship, that money feels spent. To the human brain, it is a sunk cost.
Right, the credit card bill was paid months ago.
Exactly. So when they are finally on vacation,
Yeah.
they look at their bank account, they feel flush with cash, and they end up spending even more on board.
Because it feels like free money.
It feels like free money. Carnival is capturing revenue months before the ship ever leaves the dock, which swells that $7.9 billion deposit war chest and gives them incredible liquidity.
So what does this all mean? You have an absolute mountain of cash locked in, 85% of your inventory spoken for, and record margin yields. What do you do next?
That is the big question.
Because Carnival didn't just report a good quarter here. They basically announced they had finished their old corporate strategy entirely.
They did. Their previous strategy was called CEA Change. It was essentially their post-pandemic recovery roadmap focused on digging out of the massive debt hole caused by the global shutdown.
And they pulled it off.
They absolutely crushed it. They hit their 2026 targets 18 months early.
Wow.
Yeah, they achieved a 50% increase in adjusted EBITDA per ALBD compared to 2023, and they hit a 12% adjusted return on invested capital.
It's like a marathon runner who finishes their race an hour early, doesn't even stop for water, and immediately starts sprinting a brand new route.
That is a great way to put it.
Because right in this presentation, they introduced their new strategic era. They are calling it PROPEL, Powering Growth and Returns Responsibly.
Yes.
And the targets they set through 2029 are wild.
They are highly aggressive. Under PROPEL, they are targeting greater than 16% return on invested capital, or ROIC,
Okay.
and they want to see more than 50% adjusted EPS growth from 2025 levels.
Just to ground that ROIC number for a second. An ROIC of 16% basically means that for every dollar they sink into a new ship, a new marketing campaign, or a private island, They are extracting 16 cents of pure profit from that investment every single year, correct?
That is a perfect way to conceptualize it. It is a measure of how efficiently they use capital to generate wealth.
Got it.
But the headline that Wall Street is truly fixated on is their new shareholder return plan. Over the course of the PROPEL strategy, they are expecting to distribute more than 40% of their cash from operations straight back to shareholders.
Which, looking at the projections, translates to approximately $14 billion by 2029.
A massive number.
Right. And they are starting this right now with a newly announced $2.5 billion share buyback program, plus over $800 million in expected 2026 dividends alone.
They are definitely not waiting around.
But I have to push back here. With $14 billion promised to shareholders, are they risking starving the actual cruise lines of innovation just to keep Wall Street happy?
It's a fair question.
Because you can't just hand out $14 billion in cash and still afford to build the biggest, craziest new megaships, right? Doesn't the product eventually suffer?
If we connect this to the bigger picture, this is actually the most critical strategic pivot in the entire report.
Okay, lay it out for me.
Carnival isn't starving the business. They are fundamentally shifting from a recovery phase to a highly disciplined harvesting phase.
Harvesting.
Yes. You have to remember the sheer scale of their portfolio. They don't just own Carnival Cruise Line.
Right, there are others.
They own Ada in Germany, Costa in Italy, Cunard, Holland America, Princess, Seabourn.
It's a massive umbrella.
It is.
Yeah.
They are utilizing that massive, already existing global scale to generate immense free cash flow rather than pouring all their profits back into constantly expanding the physical fleet.
Okay, if they are entering a harvesting phase, how do they actually hit those massive PROPEL targets without flooding the ocean with new inventory?
That's the trick.
Because historically, growth in the cruise industry means one thing: building more ships to hold more people.
They are completely flipping the historical playbook. They are employing what they call intentionally measured capacity growth.
Meaning?
For the entire 4-year PROPEL period, from 2026 to 2029, they only have 3 ship deliveries planned across the entire global company.
Wow. Only 3 ships over 4 years for the largest cruise company in the world.
Very restricted.
This sounds exactly like the velvet rope strategy at an exclusive nightclub. By practically stopping the rollout of new ships, they're artificially limiting supply, while demand, as we saw with those 2027 bookings, is absolutely skyrocketing.
The demand is definitely there.
But honestly, isn't this just a fancy Wall Street sanitized term for squeezing the consumer? If you artificially cap supply and demand is through the roof, you're just jacking up the ticket price. The consumer loses.
This raises an important question about the distinction between simply price gouging and what the industry calls yield expansion.
Yield expansion. Okay, explain that.
I understand why it looks like a squeeze, but Carnival isn't just jacking up prices for the exact same product.
They aren't.
No, they are focused on getting more value out of their existing assets by changing the product mix. Instead of taking on billions of dollars in debt at high interest rates to build a brand new megaship from scratch, they are investing heavily in return-generating midlife refurbishments.
Like flipping a house instead of buying an empty lot and building a new one.
Precisely like flipping a house. Take their Ada Evolution program, for example.
What's that?
They are taking older ships, like the Ada Luna, and giving them massive overhauls. 3 of their 7 ships in that class are already upgraded, and another one of their cruise lines is announcing a similar modernization program next month.
So they basically gut them and redo them.
Exactly. What this entails is taking a 15-year-old ship that is fully paid off and investing a fraction of what a new ship costs to add high-margin luxury suites, exclusive specialty restaurants, and premium spa services.
Ah, I see.
They fundamentally elevate the ship's earning potential. Your capital expenditure is incredibly low, but your yield skyrockets because people are willing to pay a premium for those new amenities.
And it's not just the ships themselves, right? The report leans heavily into what they call their destination portfolio.
Yes, the private islands.
It seems like they're monetizing the land just as aggressively as the sea.
Absolutely. They are building out exclusive walled gardens where they capture 100% of your vacation spend.
Right. They highlight Celebration Key in the Bahamas, which is this massive new private destination opening up to multiple lines within their portfolio, like Carnival, Princess, and Ada.
It's going to be huge.
And they have Relaxaway at Half Moon Cay. They even highlight land-based assets like the Denali Princess Wilderness Lodge in Alaska.
It is brilliant capital allocation. Think about the mechanics of a normal port stop.
Okay.
When a ship docks in a public port, the cruise line pays port fees to the local government, and when passengers get off the ship, they spend their money at local restaurants and independent tour operators.
The local economy gets the cash.
Right. But at a private island like Celebration Key, Carnival owns the dock, they own the restaurants, they own the cabanas, and they own the excursions. The profit margins are exponentially higher.
Okay, so they are upgrading older ships instead of building new ones to save money, and they are driving those ships to private islands to maximize profit.
Exactly.
But an older ship is essentially a massive gas guzzler. How do you keep environmental regulators and fuel costs off your back if you're keeping 15-year-old engines on the water?
What's fascinating here is how deeply intertwined their environmental goals are with their financial survival.
Because it's expensive to burn that much fuel.
Yes. This brings us to the responsibly part of the PROPEL acronym. As part of their previous sea change goals, they achieved a greater than 20% carbon intensity reduction 18 months ahead of schedule.
Impressive.
And now, under the new PROPEL strategy, they are targeting a greater than 25% reduction in their overall greenhouse gas emissions rate compared to 2019.
Being green is literally saving them green.
It really is.
But how does a company that relies on burning millions of tons of fossil fuel to move floating cities around the world actually achieve a 25% reduction without destroying their operating margins?
They achieve it through incredibly sophisticated operational tech. When they do these midlife refurbishments, they aren't just adding fancy restaurants.
What else are they doing?
They are installing hydrodynamic upgrades.
Stop right there. Hydrodynamic upgrades. What does that actually mean mechanically?
Think about moving your hand through a swimming pool. You feel the resistance, the drag of the water.
Right.
Now imagine if you could coat your hand in a microscopic layer of air bubbles. The friction drops dramatically.
Okay.
Carnival is installing air lubrication systems that literally pump a carpet of microbubbles under the hull of the ship, reducing drag.
No way. Bubbles.
Yes. They're also applying advanced silicone hull coatings that make the ship slice through the water more easily.
That is wild. They're basically making the ship slippery.
Exactly. Add to that better route planning algorithms. Think of it like Waze, but for massive cargo ships, helping captains catch currents and avoid heavy weather, and highly efficient HVAC systems that reduce the internal energy load.
All that adds up.
It does. They are also strictly targeting a 2.75 times net debt to adjusted EBITDA ratio. That financial metric ensures they maintain a healthy enough balance sheet to actually afford the upfront capital required for these technological investments.
Let's bring this all the way back to the very beginning. We started this deep dive talking about that $500 million headwind from fuel prices.
We did.
They didn't just survive that by raising ticket prices.
Not at all. If you look at the raw data, their actual fuel consumption per ALBD dropped by 4.7% in the first quarter alone.
So that 4.7% drop in fuel consumption isn't just a fun sustainability fact for a corporate brochure.
It is a critical operational defense mechanism. By burning 4.7% less fuel per passenger, they fundamentally blunted the impact of oil prices spiking globally.
It's all connected.
Yes. That hidden architecture of efficiency is exactly what allowed them to post a $150 million operational improvement and achieve record profits, while the cost of their primary resource was surging. They didn't just charge more, they built a significantly more resilient machine.
So, to put a bow on all of this, we started by looking at a massive global company staring down a $500 million fuel spike that should have crippled their quarter.
And it didn't.
No. We discovered how ferocious consumer demand, specifically the sunk cost psychology of pre-booking vacations and onboard drink packages years in advance, created a $7.9 billion cash fortress that insulated them from the storm.
Huge safety net.
Right. We saw how they crushed their pandemic recovery goals a year and a half early, and learned how Carnival's brand new PROPEL strategy will use a velvet rope model of intentional scarcity, highly profitable midlife ship refurbishments, and aggressive fuel efficiency to generate a staggering $14 billion for shareholders by 2029.
It really is a masterclass in shifting from a mindset of frantic capital-intensive growth to one of disciplined, highly profitable execution. They're doing more with less, and Wall Street is rewarding them for it.
But it does leave you with something to really chew on as a consumer. Think back to those 18-wheelers driving into the headwind.
Right.
Carnival figured out how to make their trucks aerodynamic enough to ignore the wind. But more importantly, they realized they don't actually need to build more trucks. They just need to artificially limit the cargo space and charge a massive premium for it.
Yeah, that's the core of it.
So if the world's largest travel companies are shifting entirely to this model of intentional scarcity, where inventory is deliberately restricted, capacity barely grows, and vacations are fully booked 18 to 24 months in advance, what does this mean for the future of spontaneous travel?
It's a great question.
If every major player adopts the velvet rope strategy, will the very idea of a last-minute getaway soon become a luxury of the past, accessible only to the ultra-wealthy who can afford to bypass that velvet rope? It is deeply worth thinking about how this shift in corporate strategy might fundamentally change the way you are forced to plan and live your own life.